What are you made of the action over the last 24, 48 hours?
Well, funny enough, I looked this morning. I just wanted to check before I came on about how markets actually have perceived when they've inverted. We got a small inversion, as you know, in March, and that was the 3-month over the 10-year, so it promptly recovered from that. But our conclusion is, having looked at the work this morning, that after, given the last 4 inversions, it's a buying signal, not a selling signal, because actually we worked out that after, those 4 inversions, you got anywhere between a 20 and a 40% increase in the stock market. And the peak was 18 months later. Now, it may have led to a recession after that. But you actually had a lot of gains. Actually, you leave on the table if you sell too early. So our observation is that it should be viewed positively and not negatively. And there are other reasons why it inverted, because of obviously QE, etc. And, the hunt for yield. And a lot of institutions, need duration, they need swaps, they need to actually participate in that market.
The German 10-year is now negative 70 this afternoon. It just keeps going. It just keeps going up and up and up. The price keeps going up and up and up. If I look at the Fed model, that would make me think that stocks are getting cheaper and cheaper and cheaper on a relative basis. I assume they are. What you just said is you want to carry on buying after the inversion. Presumably this is more evidence of it as well, that stocks on a relative basis just look cheaper now.
Well, we think it's a crowded trade, the bond market. Certainly, looking at it simply, I've been in this business 30 plus years, and any time that the S&P yields, more than the 10-year Treasury, it's been a screaming buy. So just simply put, it's a hunt for yield. People are worried about the financial crisis. You pick up any newspaper today, I picked up the FT this morning, it talked about a global recession. Everybody's on that story, so they're looking for protection. I think talking to clients recently, they're the most hedged they've ever been. They're actually hedging 30–40% of their portfolios. And if you look at the sentiment indicators in the States, they're the most negative they've been for some while. So people are positioned very cautiously. So, if 1 or 2 things start to actually look a little bit better, whether that's Hong Kong, where there's a trade deal, this stock could explode to the upside quite easily.
But Patrick, doesn't it matter why the spreads are narrowing and why the portions of the yield curve that are inverting are inverting? If it's for reasons other than slowing growth and the data clearly slowing, which they're not, then does it make it possible that this time is actually different?
Well, that's a good question. But as I say, if you go back to the pure valuations of the equity market, it's really where you want to be invested. And certainly, if you look at the return you're getting on 10-year, it's literally about 55 times earnings, which to me seems ridiculously expensive. Whereas in the States you get you can get over 2% yields on 15, 16 times. So it's a no-brainer to us. I understand that it might be different this time because of QE, but that doesn't necessarily mean that the asset allocation to equities is wrong. And I think it's very wrong. I think you should be very long equities here.
So then, where are we in the bull market for equities, Patrick? It sounds like you think we have a long way to go.
Well, I think we're most probably mid-cycle. Obviously, there's been concerns recently that we're late cycle, but I think the Fed will, potentially do 50 basis points in September. There's some probability of that. So that just extends. That'll most probably, first of all, get rid of the yield inversion. But secondly, that will most probably push out the recovery. So rather than being late cycle, we're mid-cycle. So, we still like, for that reason, consumer discretionary stocks. And to that point, 70% of the US is consumer, and the consumer is still in rude shape. I mean, certainly if you look at the employment situation, if you look at the low interest rates, if you look at the refinancing of mortgages, look at low oil prices, you've just recently had tax cuts, they're in pretty good shape. If you looked at retail sales this morning, they're strong. So the US consumer is still in good shape. So consumer discretionary, we still like tech. And we have been a little bit cautious of late, and we did add a little bit of exposure to REITs, utilities, and a bit of gold. But, you know, our major overweights are basically actually in cyclical and risk-on stocks.